We wanted to work hard. We wanted to win. But we wanted to have fun while we were doing it.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. We are in the dog days of the never-ending shutdown, and we have a very special show today. State Street Global Advisors is a $725 billion ETF issuer with household name products such as SPY, GLD, the Select Sector Spiders, and many, many more. The driving force behind building the ETF juggernaut there has been Jim Ross. Jim is a legend in the ETF industry, and I'm honored to have him join us today to discuss his career, building companies, and what's next in the asset management industry. Jim, thank you for joining the podcast.
Phil, thanks for having me on. I'm excited to do this.
So where are you located right now? What does your COVID bunker setup look like?
So the COVID bunker is in Laconia, New Hampshire on Lake Winnisquam, where we've had a house for, I think this is our 11th summer at this house, but I've been coming up here for over 20 years. And it gives us a little bit more space than we have in our 2-bedroom apartment in a condo building downtown Boston with 160 other units.
Yeah. And how are you getting through? How has it been?
We're getting through it. It's, obviously we're not having as many guests as we would normally have up. Pretty much just been some of our family and a couple of good friends. And we're just getting through it. The good thing for me is I play golf. Golf's open. I'm walking and riding my bike a hell of a lot more than I ever have. And that's pretty much getting me through it. And kept involved, obviously, in some business stuff that we'll talk about. So that's kept me a little bit busy from a business standpoint. But yeah, my last day at State Street, I retired in the middle of this thing. I retired on March 31st. So my last 3 weeks were a little strange.
Yeah, I'll bet. So let's start here. Let's start with this story about how you raised your hand on a new initiative that nobody had heard of and took on the development of the first ETF. And that really led to everything to come. Tell us that story. Tell us how you happened to take on the first build out of the first ETF.
Yeah, so it's a strange story, Phil. I'm just going to be candid with you. So I joined State Street in a fund administration role, which is basically doing 40 Act compliance and financial reporting in July of 1992. And it was a job. I was in public accounting. I did my 3 years. I didn't love it. So I'm like, this seemed like a good enough job. I had some experience auditing mutual funds. They liked my experience. I'm like, okay, great. I get on board. They don't have a lot of clients yet. This is a new business for them. It's actually called the emerging business unit within State Street Asset Servicing. And I'm like, okay. So, didn't have much work, to put it nicely. My boss was a really nice guy, young guy, 31 years old. He goes on vacation at the end of August, gets sick, never comes back, passes away. So that's a sad story. Here I am. I got a group of people working for me. My boss's boss knows I'm working, but doesn't know exactly what I'm doing. And I'm sitting there and finally I just went to him. I said, listen, I got enough work for about 20 hours right now. I'm like, I need more. And he's like, oh, we're working on clients. I said, well, if there's anything I can get involved in that will help me he's like, Jim, keep doing what you're doing. We really like you. But, obviously we're trying to figure out how to do everything right now without Richard. I'm okay. So I'm there one night at my desk and probably a little late. I could find a way of keeping myself busy. Because I came out of public accounting. We used to work in 70, 80 hours a week. So, and he looks over and he says, you were looking for more work a couple of weeks ago, right? I'm like, yeah. He goes, hey, come on over here. We have this project. And there was a bunch of people working on something. I had no idea what it was. Well, they were working on the development of SPY. And frankly, they needed me because they needed someone who could do financial statements. So that was my drag into SPY. It was probably October, November of 1992. So as far as I get, people give me credit for SPY all the time. All the hard work was done. I was just coming in really to bring coffee to people and kind of make sure we got this thing launched from a financial reporting standpoint, which was fun and interesting. But I like I said, I get a lot of credit for SPY. I don't think I deserve any of it. I've done a few things since then. I think it brought some value to the ETF business in the ETF industry.
Yeah, I think you're being a little bit humble with that. And when you look at the success that you've had and the success that State Street had, along the way, there must have been countless pitfalls, countless ways that SSGA might not have been such a success or things might not have gone smoothly or even launched at all. What were some of those pitfalls and how did you manage to avoid them?
So there was always pitfalls. I mean, there's always challenges, I mean, candidly, if you read SPA's original prospectus, there was concern that this thing wouldn't be successful, wouldn't grow. Matter of fact, there was automatic termination provisions that after 2 years, it wasn't more than $350 million because it's really hard to terminate UITs. So I think from that perspective, we kind of looked at, going on, our first pitfall was we didn't win the business for QQQ. We could have, but somehow that went a different route. We're like, oh, wow, that was surprising to us. Obviously, that's a little bit of a miss. But I think, when I think of the pitfalls, it was just at the time we had worked with the American Stock Exchange to launch what was going to be an institutional trading product. And the vision wasn't for retail. So I think the pitfall was not really seeing some of the benefits. As a matter of fact, it was something we did in 1996 when Aol Time Warner merged. It caused a tax potential distribution on SPY. And someone said, hey, had we handled that differently, just from a tax law perspective, we could eliminate that. And that's when ETFs became tax efficient. So I think there was a lot of pitfalls in the beginning. I think you've seen them all, anytime you see somebody launch something, you're like, oh, we thought of that, and then we didn't go with it. I think anytime you're doing product development, there's always going to be something you feel bad about. I think from a State Street perspective, BGI at the time came in and made a huge commitment to this business because it was their entire investment to try and get into U.S. retail, whereas State Street at the time had other competing priorities, and a lot of them, and so did SSGA. And so we didn't invest as much in the early 2000s, and that's probably my biggest pitfall, to be honest with you.
I did not know that the AOL Time Warner merger in 1996, that famous merger, was what led to. Is that what led to the IRS private letter ruling about in-kind creation? And
well, I mean, I think we'd had the IRS letter ruling, but it was more that we could then do lowest cost first out on the baskets and highest cost on ETF trades from mergers, so from true corporate actions. And that really helped.
Yeah, absolutely.
But I think there was a whole bunch of nuanced things in there that were pretty interesting.
What was the moment that you realized how big ETFs could be?
Oh, it was probably somewhere in the 2000s to 2000. I'm going to put it in the 2007 to 10 range. And even coming through the crisis, we saw how they did well. I mean, they were growing before, but I think the financial crisis was really one of the things that set them off on a different tangent. And because they continued to do what they needed to do, and people continued to access them for liquidity, but also continued to look at the different ways that their active portfolios didn't work for them, and how ETFs might be a better way to build a business of investing for their clients. So that's really kind of when I think about the growth triggers that we saw. I mean, there was some in the early 2000s, but candidly in the early days, when it's just cottage indexes, a lot of the people who like to invest weren't all that interested. When it was just BGI, State Street, a couple of smaller providers, and then even when Vanguard came in, they came in as vipers, and they weren't committed. I mean, they became committed. We all know that when they rebranded. But I think in the early days, it was kind of like, yeah, these are just cottage indexes calling on us, financial advisors. We might use some of their products, but we're not all that interested in transitioning how we think of what we deliver to our clients in a holistic sense. But we might use these for tax loss harvesting and stuff like that. I think it was when post-financial crisis, when you could see the potential of building really good portfolios with ETFs, that we started to see much more adoption.
Was that reluctance due to the fact that people just perceived ETFs are just broad vanilla indexes, at least at the time, and there's nothing sexy about that, there's nothing interesting about that for my clients? Or was it related to the product structure that people didn't want to have to trade it on a secondary or didn't understand the trading? What was that early reluctance and hesitation?
I think most of the reluctance, it wasn't necessarily the trading of them, because most of these advisors had been trading stocks, so they knew they could trade an ETF, but it was explaining why they're putting their clients into something that new the clients never heard of. So ETFs weren't very well known to the end client. So I think, okay, there's that question. They're passive, so then the client's going to be asking, what are you actually doing for me if you're just putting me in 10 ETFs? And frankly, there wasn't enough product. So you couldn't really get into truly diversified products until you got probably into until you got into the mid 2005, 6, 7, 8, when you got much more products in fixed income and international equity. That I think allowed for advisors to look at these. I'm focused more on the FAs because they were really the early adopters in the 2000s, and they were the bread and butter for growing an ETF business. The institutions came in later. I mean, I shouldn't say. Some institutions were trading these things all day long, but buy and hold institutions were hesitant probably to oppose financial crisis.
And I think they still are. I think that's still the segment where there's going to be the most growth in the future. I think there's still a feeling among a lot of institutions that ETFs are still only vanilla broad indexes. And the fact that you can get alpha strategies or even hedge fund strategies now in the ETF vehicle still seems to be very dismissed by the institutional world.
Yeah, I think, well, listen, the institutional world, one of the challenges there is institution comes to a large investment manager like State Street and says, I want you to manage S&P 500 for me. SPY is expensive compared to what we'll do S&P 500 for as a indexer in a separately managed account or a commingled trust fund at State Street. And even the lower price S&P 500 ETFs today, which SPY now has one at 3 basis points, are more expensive than what you'll do a private account for with a large institutional investor. Think the big ones. They do get beneficial pricing.
Yeah, absolutely. Well, along the way, along the way of building out almost 200 products, what were some of the more interesting fund launches during your career, or maybe even projects that never even saw the light of day or weren't commercial successes, but that the product development part of it that you had that were the most interesting from your perspective?
Obviously, some of the hallmark launches were a lot of fun. GLD was a trip. I'm not going to kid you. Obviously, partnering with the World Gold Council and some good friends that were there at the time. So Stuart Thomas was there, but it was, we won that distribution mandate, and it was controversial within State Street, within SSGA, because it was the first time we weren't managing the money. And some folks were really doubtful about it. Like, I don't think we should be doing this. And candidly, our distribution size at that point in time wasn't that big. And our phones were ringing off the hook. So that day, we're all excited and happy. And I get back to the office from New York. I was down for the opening bell and stuff like that. And the head of our internal desk, Joe McNolan, pulls me aside and says, look what you did to me. And the phones are just ringing. And we don't have enough people to even answer them, Phil. But it's ringing because it's people calling up. So if I buy a share of this, you'll send me one of those shiny gold bars? I'm like, no, that's not how this works. We're not delivering out at the time, I think, a $400,000 gold bar because you bought a $40 share. But okay. So GLD was a lot of fun. I think of some other ones, over the years, and Sector Spiders was a lot of fun. That's going back to 1998. The funny thing about Sector Spiders is that's probably one of the early ETF launches I worked my hardest on. But I was still a junior person at State Street. And the day before, I get a call from my boss's boss. Might have been my boss's boss's boss at the time. And she goes, Jim, can you go to New York tomorrow? I'm like, sure. The answer is yes. I knew that. She goes, good. We need someone to ring the bell for Sector Spiders. I called the CEO of State Street. He can't make it. I can't make it. Can you go? I'm like, yeah, sure. I go to New York. And of course, I take a later shuttle than I should have, New York traffic. And I'm getting to the exchange. And Mike Bickford, who was head of marketing at the time, is sweating. Getting there about 9:20. Yeah, you can see why he was sweaty. Waiting downstairs. They had me clear for security, fly me up. I do the bell. It was really cool. Kevin Ireland was there at the time. And I'm like, hey, do I get to take the hammer? I'm like, yeah, take the hammer home. So it was literally blue and white tape. I still have it. It's probably one of my mementos I would never get rid of. But it wasn't a fancy hammer. It was a blue and white tape thing. And I guess the next time they were doing a bell, they were looking for it. And they had to go find another one because I had taken it with me.
Oh, that's amazing. And they didn't know.
Yeah, they didn't. Well, Kevin knew, but I'm not sure he told whoever he was supposed to tell. So
yeah, he didn't work for the exchange.
Yeah. So sometimes, things get lost. But those are some of them. I mean, listen, there's been a lot of fun launches. I mean, launching the first active fixed income ETF with GSO Blackstone, launching with Gunlack, and TOTL. And that was a ton of fun. Just getting kind of some of those things up and off the ground and just working with some great people, some really, really fantastic firms. I always like the ones, Phil, and it's going to sound strange, where we were truly partnering with somebody outside of State Street. And I don't just mean an index provider. It just brought more to it, I thought. Not that we didn't do some great products at State Street, we did. But it was more fun like when you were working with the World Gold Council. or, Double Line, GSO, Blackstone, those folks. It's been a lot of fun.
Yeah, that's funny you say that because currently at Exponential ETFs, we partner with other asset managers and help them launch funds. We do trading and sub-advisory and some other services. And I agree, when you have someone who's very passionate about their investment methodology and you help them get it out to market and you help them launch, and they can really take the lion's share of the spokesman's role for the product and the methodology and what it could do for people, but they're passionate about it and they bring that, you feel like you're helping other people achieve the dream at the same time you're doing yours. And there's a really fun dynamic and a good partnership that comes when it's just internally the same people working on, yet another, product to get it out the door. You don't have quite that same driving force behind it. You don't have quite the same energy and enthusiasm with it.
Yeah, no. And let me tell you, when you have a sales meeting going on and you have all of your sales folks in the same room and you walk up as the closing announcement, because we had just got the commitment that we were filing to do an ETF with Jeffrey Gundlach and Double Line, the room explodes with clapping. Like they were like, wow, this is something different.
And he's great. And that fund has been so successful. I'm still sweating from your story about the getting to the exchange 10 minutes before the bell. I've been on the other side of that. So I've worked at the exchange and I've hosted a couple of bells. And yeah, if the bell ringer is not there, you start to panic because 9:30 comes and there's no holding back the market or the 500 TV channels that capture the feed. So I
planned better in the future because obviously I've done a few bells since then, but that one I was kind of a rookie. Didn't really understand New York traffic all that much. And even funnier than that, Phil, and you'll know this from your days at the exchange, is at the end of the bell ringing, first thing they say, okay, Jim, great. Now let's go introduce you to some of the media folks. And I looked at them, I said, I'm not media trained. I'm not allowed to talk to the media. And I'm calling my boss. She's like, no, you can't. And they're like, but Jim, that's one of the best opportunities right now. We have all this media. I'm like, yeah, sorry. I got media trained after that.
I'll bet you did. And that kind of speaks to the difference of being with a large company, a large corporation versus being with a smaller company. If you had managed an ETF, if State Street all along had been a smaller company, let's say you had 100% discretion and ownership over the direction of the company, are there things that would have been different?
Well, you know what? What would have been different is you wouldn't have had, well, I guess it depends. I mean, obviously, if it's the same company, some things I think might have been different with a different lens on where you invest. But I think as a company, as a big global bank, and even as SSGA at the time, what SSGA did brilliantly back in those days was invest in their global network, which is still probably one of the strongest global networks of a large global asset manager, which helped me tremendously when we went to launch ETFs. But they were building offices in London and Sydney and Hong Kong and built really great presences with clients from around the world, which made it easier for me to go then launch ETFs in those countries, and allowed us to launch the first ETF in Hong Kong with the Hong Kong government, allowed us to launch the first ETFs in Australia. But I didn't have to go try and set up a new office and figure out how to, in London, figure out how to use the tube. I had colleagues there that could help. It was really helpful. But I think if I was looking at this as 100% ownership, I think we probably would have put more early investment into the ETF business. But we weren't, State Street initially wasn't in it from a distribution standpoint. So when it came to SPY, diamonds, sector spiders, we were only hired to manage the money and custody and administer the assets. So it wasn't until we saw a potential opportunity to launch SSGA branded ETF where we started out with a first tremendous brand called Street Tracks that we couldn't be happier to have buried, that we were really kind of launching our own stuff. So it was just a different mentality, but we were part of a very large company that had very complicated competing priorities. And that's always going to be the case. I think it was challenging in the early 2000s. Trust me, being part of a globally systemically important bank in the last 5 to 7 to 10 years was a real challenge.
Right. Yeah. But you stayed with one company for a very long time. Were there times that you considered testing the free agency market?
There's times I tested it, Phil. Come on. I tested it many times. I just never pulled the trigger. And it was two things. One, I mean, there was definitely opportunities. I'm a Boston guy. Some of them, when they wanted me to move, I'm like, yeah, I don't know if I trust that opportunity that much. But the other thing was I was fortunate in my career at State Street that anytime I felt a little bit bored in my role, there was more opportunity there. So there was something more to do. Sometimes the opportunity came because somebody else left. So somebody else pulled the trigger and, hey, now, Jim, you're responsible for distribution. I'm like, hey, that's great. looking forward to this. So I think, I was fortunate in that I had some opportunities to grow on the State Street Bank side at first. And then in 2000, I made a decision to leave what was a pretty good job in the State Street side. And I had probably had 60 or 70 people working for me, which at State Street meant something. And I went to SSGA to join the ETF team. And it was going to be 3 of us. I was going to have no one working for me. In fact, I was going to be more the grunt guy in certain aspects of this, but we were going to build an ETF business. And I'm like, I want to go try that. And my boss at State Street at the time was like, not a fan of it. She said, Jim, you have a great career here. Why would you take that risk? I'm like, I don't know, but it seems like I want to be there. And those were the early days. They were a lot of fun.
Yeah, and it was a great call, of course.
Yeah, it ended up being a really good call. And SSGA was just a little bit more, I think at the time, innovative than a traditional custody bank side was. So we definitely could do some more things. And I got to work with some great people. Gus Flatus, who hired me, helped me understand the investment management side of the business much better than I ever did. And that's where I got to meet Greg Arrett, who's been a close colleague and personal friend of mine for a number of years now.
Well, let's discuss the current state of the asset management industry. I'll throw out some topics. We could do like a lightning round, but I'd love to hear your thoughts on a few of the bigger themes that are going on in the asset management space right now. So let's start with the fee war.
Challenging. And if you're not in it, don't. Just don't. Because the reality is the fee war, you need SaaS or captive assets, and you need one or the other.
Yeah, I think that's fair. I mean, that's what I've observed is that there are more players going for the scale game than there is scale to feed all those mouths. So there's only so many people that can make, money at single digit basis points that can make, real money, and the massive amount of scale you need to get there. Well, once you've got State Street, iShares, Schwab, and Vanguard, there's not a lot left to really play in that. Well, the other side of super low cost in the fee war is, of course, active management, where you can charge a premium. Presumably, if you can outperform, that is worth a premium if you can consistently outperform. What's your take on the current state of active management?
Yeah, I believe in active management. I believe in active results, I should say. Does that necessarily mean I believe in active management? It depends. Once again, you can have consistent outperformance for a number of years, but the stats always show that most don't. And then you try and make sure you have to select the right active manager, and then you have to keep watching them. Are they still delivering? And there's a lot to it. But when I say active outcomes, people using ETFs are trying to get to active outcomes. They're not, there's very few people that are doing the couch potato ETF portfolio and buying 2 ETFs to get global equity and 2 ETFs to get global bonds and letting it ride. They're trying to outperform. So I think the misnomer for me is people think ETFs aren't used for active. I'm like, they are. They're used as a way for people to try and outperform the markets instead of buying individual stocks and bonds. But I think I'm a huge fan of active management. I'm less of a fan of active mutual funds.
Mm-hmm. How about the changing distribution landscape? So how the distribution model is changing? It
continues to evolve. I mean, it continues to be, a number of times we changed distribution models. When I was at State Street, was a lot. Do you de-channelize? Do you channelize? How do you get the right clients? What's the right opportunities out there? The independents are now adopting ETFs. How do we get more coverage there? How do you get into the model ETF portfolio business now? So there's a lot of changing distribution landscapes. And I think that's always going to be the case because the large distributors distributors with the clients continue to change. No one wanted the ETF model delivery 5 years ago because the tech wasn't there to do it well, if you know what I mean. But now that the tech has improved, I think a lot of the underlying changes we're seeing is because of technology improvements. I ran a separately managed account business when I first joined SSGA, and it was an awful business. You would hear the fax machine going, and that's how you're getting accounts. And you had to then type it in. It was an awful business. I think the SMA business today is back where it was and even better because you can do UMAs. You have so much in the same portfolio, and it's pretty much all automated for the financial advisor who can execute a portfolio or fixed income or equity in a touch of a finger and get a diversified portfolio from a large asset manager of ETFs or of stocks and bonds. That's what they're trying to do. And they don't really have to do much more.
All right, last one. You ready? So, as a prelude to it, State Street very famously launched the gender diversity ETF with the ticker SHE, SHE, and incredible execution on marketing. Put the Fearless Girl statue, down by the Bull in Wall Street. Now, of course, it's in front of the Exchange building. So, with that as kind of a prelude, ESG in general, is it overhyped, or are you bullish on ESG?
I'm bullish on ESG. I think the challenge with ESG for me forever, and going back to when it was called different things, is I think it makes sense. It has to be a fabric of the investment, though, and you need the data. So I think the biggest challenge is, can you get the data to truly evaluate companies on an ESG? But I think if you can, you can prove over time that I do believe having those factors and being able to evaluate a company on environmental stuff when it's has potentially huge impact to environments. So I'm thinking oil companies, you want to understand that environmental impact. SSGA and State Street probably has less of an environmental impact of the type of business they're in. So you might want to lessen the focus on environmental there, but hey, what is State Street doing on social and governance might be much more important to what the long-term success of the company is. So to me, it's about how do you look at it from a fundamental standpoint about what the long-term success potential of that company is, and where does ESG fit in that bandwidth? But I've been back and forth because when I'm going to go back to an original branding, probably was more about social, but socially responsible. To me, that was hard to put in a commingled product because people had different views on it. And I think that's the challenge with ESG. There's going to be a lot of noise because there's a lot of different data points out there. But I do think if you can evaluate it based on what it's done for companies, does it help you avoid a wire cut, for one? Does it help you avoid the bad things that can happen if there isn't good governance at a company?
Right. And I think that the focus on ESG has really drifted away from governance and towards various social causes and social issues. And, then you get to, the ETF gives you a one size fits all, and the investor is very, everyone's got their own very specific preferences when it comes to the social side. But the governance side seems to be the least developed of the three, of environmental, social, and governance, and probably the best opportunity moving forward.
I would agree. I mean, I think the interesting about it is, you've heard this from the chairman of the SEC. He gets E, he gets S, he gets G. He doesn't understand why I put them all in the same bucket. And I think he's 100% right on the question. And I think you're going to see people try and bifurcate them once they figure out what the right answer is there. I think the challenge is for large institutional investors, we've been doing ESG portfolios forever. We'll customize an index for them. State Street would customize an index for them, or have an index customized. The number of commingled funds at State Street that have X tobacco, X firearms, X this, because large institutional investors, you're right, are very specific about what they want and have the size and scale to demand it in a customized portfolio. That's the challenge when you're trying to bring a broad benchmark product to a suite of investors and say, we think this is the best mousetrap for ESG. Everyone's going to have a different opinion.
Jim, you serve as the board of directors for the ICI, the Investment Company Institute. You're also the chairman of the ICI's Exchange Traded Funds Committee. How would you define ICI's role in the industry? And from a high level, what are the goals of ICI?
So, Phil, first of all, I'm going to put both of those in past tense because I'm no longer with State Street. So I served on the board of governors. Once you leave your post in asset management, you leave your post at the ICI. It's that simple. But that's which is fun. I actually enjoyed my years. I think I was on the board of governors for close to 10 years and chaired the ICI ETF committee pretty much since the flash crash. So really enjoyed the work I was able to do there, both at the broader industry level. Interestingly, Phil, when I'm in these board of governors meetings, which is usually around 50 or 60 heads of businesses or heads of companies in the asset management world. And in that room, obviously BlackRock is represented, Vanguard's represented. But anytime an ETF question came up, everyone just turned to me. And I'm like, BlackRock's largest ETF provider right there. But there wasn't their ETF person in the room. Vanguard's always had their CEO on the ICI board. So that was kind of fun for me at the board of governors level. But from an ETF perspective, I'm like, there's like 20 ETF sponsors in this room, but I'll answer this question. But I think I really enjoyed, and I probably enjoyed more the ICI ETF committee, although both were great. Because the ETF committee, we really did get to nuts and bolts questions about what you could do to try and improve the industry. And that was a lot of fun to me.
Right. All right. Well, the big exciting news is you recently announced that you'll be managing a SPAC, a special purpose acquisition company called Fusion Acquisition. What is the key thesis and what's the opportunity that you see?
So the key thesis is we're looking to find a great company with good management in place and help them with growth plans, strategy plans, whether that's developing international markets for them, developing, needing investment dollars to kind of expand their product line in the US or expand their distribution reach. But we're very focused on the fintech aspect of it, some type of technology or fin wealth tech angle, and really just looking at that in the fintech, asset management, or wealth management space. So we're trying to stay pretty focused on, and that just goes to the background of the team that we put together. Obviously, I bring some experience in asset management and wealth management from where we distributed over the years. We have my partner, John James, runs a fintech company today. So he runs Beta Smarts and has a really good fintech experience. The other board members really have a lot of deep experience in asset management, investment management, and evaluating companies. So we're really excited to try and partner with somebody and really help them move forward to a public listing, get the benefit of the public equity, and find a good way to try and continue to hopefully grow a good company that's already growing.
Right. And why did you choose this SPAC structure?
It was something we evaluated and looked at and said, okay, this is interesting. It was, at the time, it wasn't quite as well known as it is today. Today, there's SPAC articles all the time. I'm like, I was getting involved in this 6 months ago, 9 months ago, and I didn't know it was that popular. But I think it was just kind of, we talked to a bunch of bankers, we talked about the structure, we saw an opportunity in the space that we feel like we know our knitting in it, and we got the backing of a significant number of investors to raise a $350 million SPAC, and now we're out talking to companies about what's the best way to see where the opportunity is to bring one of them public. And I think it's a really fun time right now, because now you're starting to have the fun conversations like, are you interested? What does it look like? And it's kind of fun. For me, I gave myself two parameters post State Street. I wanted to, work with really good people that I enjoyed being with. And I wanted it to be an interesting thing that was going to challenge me to do something and think differently. And candidly, in my State Street career, I did a lot of fun things, interesting things. We didn't do a lot of M&A. So this is more M&A oriented and, working with the investment bankers. And, we did 38 roadshow meetings, all via voice or via Zoom in 4 days.
I got to say, it does sound kind of fun, with your perspective and your expertise. And I think the M&A space in the asset management industry in particular is pretty interesting. I mean, there has to be consolidation on multiple levels, and in, the upper market, the mid market. I mean, it has to come. So there's going to be some really interesting opportunities. I think it's really interesting. And
the other place, Phil, that we're continuing to evaluate is, the roll up the wealth management space and how that's changing. Whether it's independent RIAs or rolling up of small broker dealers, there's a lot of opportunity there. So it's interesting space to be kind of kicking tires in, but really looking at the wealth tech angle too, and some of the changes that are going on there, and where the winners and losers are going to be. And some of these private companies are now competing with folks who've already gone public. So they really need to consider going public just to be able to kind of keep up with the investment they need to do to compete.
Right. And there's been so much roll up within the wealth management space, but almost none within the asset management space. Why do you think that is?
Well, I mean, I think you've seen some in the asset management space over the years, but you haven't seen a lot. I think you've seen some roll ups, but not as much as I think sometimes the synergies aren't there as much unless you get in distribution synergies. And some of that has worked well, I think, for some of the more aggregators of asset management businesses. But I think there might be more synergies in the wealth management space as you're rolling up books of folks, and maybe advisors who are trying to look for their exit strategy and trying to help provide them with one while keeping them engaged as part of it, maybe for, the next 5-10 years.
Mm-hmm. Yep. Well, when you reflect back on your career so far, or at least the first half of your career with State Street and with ETFs, what advice would you offer to professionals who are earlier in their career, and what, looking back, are you most proud of from your time?
So the advice I always give people is my former boss's boss reminded me of this when I said something like, well, I have to thank you for putting me on the project. He said, you raised your hand. He goes, you didn't raise your hand specifically for the project because you didn't know about it. But you raised your hand and said you wanted more work. So to me is, as I've said to many young people, do your job. So if we hire you to be an internal, do your job as an internal. And once you've done that job, then ask what's next. Don't walk into my office 3 months after we've hired you and say, hey, what's my next thing? Because I'm probably going to throw you out of my office, candidly. But you know what? People who have worked hard have the right to raise their hand and say, I want to try different things. I had a young person work for me, one of the best analysts we had. He looked at me and says, I want to try sales. I'm like, and at the time, sales didn't work for me. So I'm like, John, you've earned the right. Go see if it works for you. Go ahead. He became our best salesperson. I took over distribution. A year later, he was my top sales guy. I'm like, okay, happy I let him roll. So that's kind of my advice to young people is do your job. Yeah, don't be shy about asking for more work or asking for what the opportunities are. And then I completely forgot the second half of your question.
What you're most proud of?
I think twofold. One, I always focused on building good teams, and we always wanted to work hard. We wanted to win, but we wanted to have fun while we were doing it. And I think for the most part, and listen, we all had challenging times, and we've all gone through times when you're not having fun because you're going through layoffs and shit like that. Excuse my French, but I think for the most part, I'm proud of the fact that collectively we built good teams that really tended to enjoy each other's company, but all had a goal of success. And I'm also proud of the work I've done across the industry, because to me that's as important. My view early on in the ETF business, when there was 3 of us or 4 of us, is we grow this thing, we're all going to win. One might win on a scale bigger than others, and that was kind of what you were fighting for. But you started out and you looked at this industry and like, okay, it's $1 trillion today. If we get it to 5, we're all going to be successful. So, let's work together to try and make sure we understand where we can collaborate and where we can't. And we collaborate a lot about product structure things. Obviously, we went through some things with the flash crash and then August 24th and things like that, and market structure questions. There was a lot of collaboration on regulation. And I think I enjoyed a lot of that because it really was fun working with industry colleagues about what you can try and solve.
Well, Jim, I like to close with this question, which is, tell me about an obstacle that you've had either in your personal life or your career that you've either found a workaround or just persisted through.
Yeah, so it's probably more persisted through, and there's probably I can think of a lot more in my one in my personal life. I was a freshman in college and 18 years old, and my father died. So we had to persist through that like that as a family, and that was not a lot of fun. It had me after 2+ years in college. I left for a year because financially I needed to, and also just frankly I wasn't that focused. I wasn't a very good student at the time. I took a year off, got a job at Ernst & Winnie at the time, working in their accounting department. And that turned into my first job once I went back to school and graduated. So I think we persisted through a lot as a family there. And that just taught me, like, sometimes you have to pick yourself back up after, screwing around for too long. And I did screw around a little bit in those first couple of years of college.
Sorry to hear about that, but that is an incredible challenge to overcome, and you've certainly overcome it. Congratulations on a remarkable career at State Street, a remarkable career so far. Congratulations on launching the SPAC. So hopefully on another remarkable career to come. And thank you for coming on the show.
No, Phil, thanks a lot for having me. I really appreciate it. And I really enjoyed doing this. Thanks, and keep up the good work.
All right. Thank you. And thank you to our listeners for your time and attention. Please subscribe to get future episodes directly to your phone. And we'll be back with a new show next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.